Hello, everyone, and thank you for joining us. My name is Heather Hansen, and I'm the Director of Alumni Engagement for the Leeds School of Business. We're excited to have Dr. Richard Wobbekind presenting on the economic outlook for 2017 for today's webinar. A few housekeeping items before we begin. First, if you have any questions now or during the presentation that you would like to ask Rich, please send a question through the chat interface. I will monitor questions as they are submitted, and Rich will respond to them at the end of the presentation. As a reminder, for optimum audio quality, we do have everyone on mute except for myself and our speaker. If you experience any technical difficulties during the webinar, please notify us through the chat interface, and one of our support specialists will touch base soon. Lastly, a link to access the webinar and recording will be sent to all registrants tomorrow, along with a survey link and supplemental resources from today's presentation. Now I'd like to introduce today's speaker. Dr. Richard L. Wobbekind is Executive Director of the Business Research Division, Associate Professor of Business Economics and Finance, and Senior Associate Dean for Academic Programs at the Leeds School of Business. Rich teaches MBA students in macroeconomics, public policy, and entrepreneurship. He has lived in Colorado for 40 years and has spent much of his time studying the development of the Colorado and regional economies. Rich received a BA in economics from Bucknell University and an MA and PhD in economics from the University of Colorado Boulder. Welcome, Rich. We're so excited to have you here today.
Well, thank you so much for having me on, Heather, and thank you for all the great alums that are out there listening in. I really appreciate you taking some time to listen to our 52nd annual Colorado Business Economic Outlook. As many of you probably know, the Leeds School conducts this outlook annually and has been doing this, as noted, for 52 years. I have not done all 52, as Heather may have highlighted there with my time in Colorado, but I have been involved since the late 1980s and have really closely followed the economy since then. There's going to be a focus, at least in the first part, on the national economy, and then along the way we're going to change over and talk about the state economy. Our poll of participants indicated about 2/3 of you are Colorado residents, and about 1/3 are coming from a wider array of states, primarily on the western part of the United States. So it's great to have you here. Also, I'm trying something new, or we're trying something new. There's some poll questions that I'll be asking along the way that Heather's going to help me with. So we'll talk more about that as we go along. What we see now is the sorry, the screen went blank on me just for a moment. What we're looking at here is the GDP growth for the U.S. as forecast, and it is a little over 2%. And to give that a little bit of context, the forecasts were raised by many forecasters after the election of President Trump, or President-elect Trump at this point in time, by 1 to 2 of a percentage point. So not a big jump, but there was a jump for 2017 and for 2018 as well in terms of projected GDP. We look at this overall picture and expect that to generate a little bit more in the way of employment growth, not as high as it was in 2014 and 2015 in terms of monthly numbers, but plenty of employment growth when we think about the general context of absorbing new people into the labor force, new participants, graduates of college or graduates of high school, or people just entering the labor force in general. That takes about 125,000 to 130,000 jobs to accomplish that task, and the forecast is really more up in the 150 to 160 range on a monthly basis. We look at states and their overall growth, no matter where you are listening in, you can see the growth rates for the various states. The darker the brown, the higher the growth rate. You can see Colorado in specific here in the 2 to 3% range. You can also see the reds in orange states, which actually lost employment year over year. So some states are struggling. Several of those states have oil or energy types of products that are really impacting them. Oklahoma, New Mexico, North Dakota, and Wyoming in particular. And I say that of note because Colorado also had a significant energy impact in 2015 and early in 2016, and still the state is one of the faster growing states in terms of employment growth year over year. When we typically hear about labor utilization, we really are focused on unemployment rates. As you can see, the U3 rate at the tan line is the rate that we typically see in headline unemployment. Unemployment is 4.7%. But we pay a lot of attention to the top line that's there, the U6 rate, which includes people who are working but are underemployed, want to work more hours, or underemployed in terms of skill set. So it's an estimate of really how much slack there is in the economy beyond the typical people who are sitting on the sidelines and trying to get in. They're truly unemployed workers. One of the things that's happening now that we're down at 4.7% unemployment rate is that we're seeing more people coming off the sidelines into the workforce. So you can see the long-term trend here of downward labor force participation. It was driven by, since the 1960s, the male labor force participation rate being on the decline. But more recently, since about 2000, we've also seen the female participation rate on the decline. Up to that point in time, up to 2000, the female participation rate in the economy was on the rise. So we have a combination of factors, both male and female participation rates, but obviously also the aging demographic of the U.S. that's pushing on this, the baby boomers pushing on this downward participation rate. Labor is going to be tight. So when we look at the overall picture here, the upward tick is a good sign. And as any good economist, you give me one upward point, I can't really do much with it. But if you give me two upward points, I'll draw a line through it and show you that we have an upward trend in the participation rate. Seriously, I hope that we are going to see more participation because it's very, very important for the economy. So when you look at the participation rates by age brackets, you can see in the tan bar on this graph, the highest year of participation for each age bracket. As an example, on the far left, the highest participation year for 20 to 24-year-olds was 1986. And then you also, on this graphic in red, can see what the 2016 number was for participation. So substantially lower participation, as an example, in the 20 to 24-year-old age bracket. What you see, interestingly enough, on the far right-hand side is that 2016 was the peak year for 65 and above participation. And also you see 55 to 64, very high participation rates, getting very close to the peak, which was 2009. So the older demographic in the country, 55 and above, has really started to
Rich, we lost you. We can't hear you anymore. Thanks for holding on, everyone. Oh, there we go. Rich, we got you back. Yes. Yep, we got you back. Thank you.
When could you not hear me?
Just for
on this
10
slide?
seconds. Or? Yes, just this slide, correct.
Okay. Sorry for that technical difficulty on my end. So you can see this graphic, which indicates the peak year for participation for each age bracket, and also indicates the 2016 participation rate for each age cohort. And the 20 to 24-year-olds have substantially lower participation rate than at the peak year. And as you go to the right, and maybe the more interesting numbers are the increasing participation rates, 55 to 64 and 65 and above, you're getting very close to peak rates. So the baby boomers are staying in the labor force a little bit more strongly. Maybe they need more retirement. Maybe they know they're going to live longer. There's all sorts of possibilities here, but we are seeing participation from that particular group. There are other interesting pieces about labor force participation. So when we get to this next slide, we see labor force and unemployment rate, and this also graphs it against level of education. And so when you move from the left to the right, you're seeing increasingly higher levels of education, and you're seeing in the red bar lower and lower unemployment rates. So the more educated you are, the higher your labor force participation and the lower the unemployment rate is. So when we look at people who don't have a high school diploma, they're 45% participation in the labor force, which is obviously a very low rate, and they also have a highest unemployment rate up around 8%. So this is an obvious pitch for more education in general, but I have to tell you, even people who practiced in the trades, there's huge demand for replacements for plumbers and electricians, and skills that you could have an associate degree or even just some college after a high school degree, and there's a lot of demand at very good wages in that bracket as well. So again, moving from left to right, making the pitch. And by the way, if you didn't see the report that was just released, I think 2 days ago, the gap between people who have college educations and people who have high school educations and below, that gap widened to the highest level it's ever been. So we still see tremendously larger returns to higher education. As I look forward, before we go to this next slide, I'd like to ask Heather to administer the first poll. And this is a poll related to policies that have been suggested by President-elect Trump. Apologize for the truncation. The survey software only gives 5 possibilities. And so I'd like you to sort of vote on one of those 5 possibilities. And if you don't care about any of them, you can certainly not vote. But this was the attempt to sort of look at what we have coming up in front of us. So this is a quick poll.
And Rich, it does look like we're getting plenty of people to vote, so we'll give everyone about 5 more seconds to vote here. All right.
So the results from the poll, percentage-wise, 50% of you voted for infrastructure investment as what you thought would do the most for the economy, and then second, in a 30% position, corporate and personal tax reform. There is going to be a question very similar to this later that talks about what are you least optimistic about or positive about. So you will have an opportunity there, but interestingly enough, only 3% voted for healthcare and social assistance reform. So at this point, it looks like the heavy vote came in for infrastructure and for tax reform. So I'll move back to the presentation and move on to the various parts of the economy, and particularly we want to focus on the income and consumption. We're going to look at the major pieces of GDP over the next maybe 10, 12 minutes and really see what we think is driving the economy in 2017. So one thing that is very clear, the consumer has been really leading the economy over the last 4 years, or last 3 years plus this coming year, 14, 15, 16, as you can see in the right-hand graphic. GDP has been growing at 2% kind of range and a little above, and the consumer has been spending at a much larger clip. And when that's 70% of GDP, it's clearly pulling along the parts of the economy that have been less growth-oriented. Government spending has been very slow with sequestration, and business investment has been slow. And we'll talk about both of those a little bit in a moment. So looking at what's driving that consumption, one of the big things, of course, is the increase in household wealth. And you can see this illustrate over $100 trillion of household wealth accumulated at this point in time. It took a big hit, as you can see in the kind of 7-8 period where the recession came in, but has been on a fairly steady climb since then. And maybe as important is the blue at the very bottom of the screen. You can see the total liabilities, And fundamentally, we have about the same amount of debt as we did in 2008 when the sort of crash occurred. So with a much larger asset base, $20 trillion larger asset base, we're carrying the same amount of total liabilities as we were almost a decade ago, 9 years ago. So that debt looks a little differently on this particular graphic, where we're focused on how much is it cost to service that debt. So this is monthly payments that you are paying for mortgage, for student loans, for cars, car loans or car leases, depending on which one of these debt service pieces we look at. But overall, the context of this slide is for, in the past 22 years, we're really at sort of record low levels in terms of how much of personal income needs to be used on a monthly basis to pay the debt or the financial obligations that are out there. So this points to a fiscally more fit economy. The wealth certainly drives spending, consumption, the income from employment. So we have income and we have wealth and we have attractive interest rates and relatively low debt levels. All of those things say that the consumer has the ability to buy more. But the consumer has to want to buy more. So that we look at the willingness factor, and you can see the willingness we measure by the Consumer Confidence Index. This one is the Consumer Confidence Index from the Conference Board. And so when you look at this particular index, we're not at the all-time high, but we're at pre-recession sorts of numbers and on a very steady upslope. I think a lot of this has been built around the employment picture getting stronger and stronger. So we see that again with the strong upward confidence numbers. So we have ability and we have willingness, and that shows up in actual consumption. Automobile sales have been very strong in the economy. And when we look at our forecast going forward for 17, we have similar kinds of numbers in the 17 million range. We also have stronger retail and food sales projected up over 5%, again, based on the income growth and the wealth growth and the confidence in the economy. So that big piece it seems to be chugging along. Why we're a little bit more optimistic about the economy in 2017 is we also think business investment will come back. And it's been quite weak the last 2 years, down in 2016, actually, as you can see, a negative growth rate. Some of that has to do with the pre-tax profits, the left-hand graphic, where you can see 15 actually had a decline in percent decline in pre-tax profits. We think 16, when the numbers are totally assembled and revised, will show a slight negative as well. So 2 years in a row of negative corporate profits growth. Finally, we see a much stronger growth this year, and this is pre-tax, but of course if we see some tax proposals pass, corporate profit tax proposals, that ultimately could even lead to a stronger business investment. So that's the ability to invest, and again, interest rates still low, even though they've gone up a little bit. Corporate profits forecast to be positive growth this year. So you have the ability to invest. Are you willing to invest? That's measured by confidence indexes. And what we have seen these indexes or indices do in the last several months since the election, we've seen a positive upward tendency. The uncertainty of the election has been resolved, but other factors have come in as well. I'll talk about that a little bit more when I talk about the Colorado Confidence Index that we construct that is in the second part of the presentation. So moving along to a big part of the investment category is housing. And many people don't think of housing as investment. They think of it more as a consumption good, but as measured in the national income accounts and in GDP, if you will, it's considered to be residential investment. So you have non-residential investment, residential investment, business fixed investment. So you have different categories in the investment bracket. And housing is a significant one, both as a driver of employment when you have housing construction and housing employment. but also as a signal of the health of an economy at any given sort of moment in time. And the housing market nationwide, houses have appreciated. The lowest bracket is the white, and you can see West Virginia and a couple of other states up in the Northeast with very light colors where they have minimal house appreciation. Wyoming, our neighbors to the north, where they're again struggling with the energy and commodities industries at this point in time. But you also see Colorado at the other end. Give you the punchline of the story that comes up later. So we're in the top 5, and we're actually number 3 for the fastest home appreciation over time, over the last year, quarter over quarter through the third quarter. There's more to say than that. This is the nominal home prices above the 2007 peak, calculated from the Federal Housing Finance Agency. This was put together in December, but there's no updated from here. And you can see percent above the 2007 peak, so the pre-recession peak, and highlighted here are the cities in Colorado, the MSAs in Colorado, Boulder, Denver, Fort Collins, and Greeley, but you can also see significant housing price appreciation in many parts of Texas, including Austin, a major competitor to Colorado in terms of technology, companies, etc. So this gives you a little bit of a sense of what's hot and what's not. It's not just how much the appreciation occurred in the last year, but this is above previous peak before the recession. So you don't see, for example, Las Vegas on here, even though it had tremendous appreciation the past year. It's still digging itself out from the hole that occurred in 8, 9, and 10, 2008, 2009, 2010. So all of this leads to, you'd say, well, all these housing prices are going up nationwide, and isn't that a concern? And we certainly, by the way, think it's a concern in Colorado. But when we look at the national picture and housing affordability, housing not quite as affordable as it was in 2011, 2012, but still in a long run, this goes all the way back to 1981. In the long run analysis here, housing affordability is still very strong. This is a combination of incomes that people are receiving, housing prices that people are paying, and very importantly, of course, the mortgage interest rate. And while that has gone up a little, it's still very attractive in terms of the long run perspective, something I'll show you here in just another couple of minutes. So national housing starts, the long run equilibrium should be somewhere up in the 1.4, 1.5 range based on household formation, replacement of old housing stock, scrapes and all of that kind of thing. You can see we were clearly above that for the first part of the decade, the past decade, 2001 through 2006, the serious overbuild, the housing bubble bursting, and you can sort of see the build back since. And frankly, most economists, business economists, including me, thought that recovery back up to the 1.4, 1.5 range would be faster than it's been. We expected bigger jumps in 14, 15, and 16, and now we don't have it getting there until 2018, up to the 1.4 range. So economy, at least from a housing perspective, continues to be relatively tight, and that is part of why we see housing prices appreciating in the entire country, but rapidly appreciating in certain areas like Colorado. The federal budget, this is projected without looking at, without knowing the actual proposals that will be put in place. So this is pre-Trump, pre-President Trump enactments that will go forward in the next 6 months or more. By the way, the tax number was one of the big ones. We don't really expect to see any true impact from that in terms of actual proposals passed and put in place until the summer or even early fall. So we'll see where that happens. But it's not going to happen in February. It's not one of those things that can be done overnight, passed, and put in place. Looking at the international picture, one of the concerns, of course, is the value of the dollar. There are probably other concerns that are more policy related. We'll talk more about that in a moment, or at least suggest that that might be more problematic. But the value of the dollar continuing to be strong, monetary policy in the U.S. supporting that, monetary policy in other parts of the world also supporting the same concept, meaning negative interest rates and flooding liquidity in many parts of the world continues to make help the dollar be a very strong currency. Yesterday, President-elect Trump talked down the dollar, and we actually had a negative downward pressure on the dollar, but all indications are the dollar will remain quite strong and potentially even stronger depending on U.S. Federal Reserve policy. So that's a nice transition as we move into Federal Reserve policy, and we talk a little bit about what we see going on there. And back before the December increase, I was suggesting there would be a December increase and 2 increases in 2017. The Federal Reserve at their meeting did the increase and suggested 3 increases in 2017. And this is one of the questions, might there even be 4 quarter-point increases in 2017? We certainly think over the next 2 years, which you see 2018 on the slide, going to see quite a bit of movement upward in the short-term rate up to the 2% range, and again, small increments, 25 basis points, a quarter of a point increase at a time. So that leads to this sort of upward trend we see going on the graphic here. And I guess the point there is certainly the Fed is going to make moves as they see fit. They're watching very closely the inflation numbers. Inflation numbers are a little bit higher, but they're still well within the range at this point to take a very moderate pace of increases over the next 2 years, not to worry about having to do anything too rapidly. I should also say before I move on, I'm looking at the time and trying to make sure I leave ample time for questions. One sort of quick point on the monetary policy would be looking at the Fed as, in some sense, being relieved. They have Federal Reserve policy has been truly supporting the economy over the last 4 years with 4 or 5 years with the zero interest rates, and with at the same time government spending being constrained with sequestration and other things. So the combination of a very tight fiscal policy was putting a lot of pressure on monetary policy to sort of keep the economy growing. Now with suggested changes in fiscal policy, tax cuts, personal and business tax cuts, and also the infrastructure spending that has been suggested, if those things happen, that certainly would be somewhat significant fiscal stimulus and would take a lot of pressure off the Fed to have to worry about keeping the economy going. So it really gives them more latitude, if you will, with monetary policy. And again, this slide highlights the inflation numbers, which when you look at the core inflation, which is an important piece, the blue, all items less food and energy, we're right around the 2% number. When you look at shelter specifically, which a lot of people point to and say, how can the CPI be so low when housing prices are going up so much? And what you see in this particular case is the shelter piece growing more like a 3.5% annual increase. Again, this is national. So this is our summary of trade and strong value of the dollar, GDP growth nearing potential. You can see the slides in front of you as you look at this, rising but low interest rates in a, again, in historical context, inflation moderate but a future concern, and that's certainly the way the Fed's been approaching that. So with that, I'd like to ask Heather to put out the second poll and give you just a minute or so to respond to the second poll, which is, again, as I suggested earlier, very similar to the first one, same sorts of issues, and again truncated because we were forced to put them into 5 buckets by the software. But which of the following economic policy proposals from President-elect Trump gives you the most cause for concern? Which of these things do you potentially not agree with, if you will, as policies that might be put in place?
Great, and it looks like we have around 80% of you who have voted, so we'll give you 5 more seconds.
So coming out of this particular survey, and again, we have I'm sure a wide array of people based on looking at who registered for the call. Immigration and trade reform had the highest response, 46%. Second highest response was healthcare, the Affordable Care Act, and social assistance reform with 41%. So those 2 pieces accounted for 87% of areas of concern, if you will. And then nothing on the infrastructure. Nobody voted negatively on the infrastructure. Regulatory reform, 8%. Corporate and personal tax reform, 6%. So again, strong support. Negative support, if you will, for the healthcare and immigration and trade as we go forward. So things to keep in mind for me while I move forward in the presentation and talk a little bit about some of these other issues that are out there. So again, looking at the broader picture, I slid one of them, just a beautiful picture of the campus. I figured you needed to see one of these as CU alums. So there's a beautiful picture of the campus from right out in front of our building, the Leeds building. And then as we look at the various pieces of Colorado, again, for the non-Colorado people, I do plan on doing this relatively rapidly, going through the remainder of the slide. So as we look at the picture here, if you want to stay engaged, that's great. If you want to hear about Colorado, if not, in probably 10 to 15 minutes, we'll be going to Q&A. So just to give you a heads up on that. So we're one of the fastest growing states for population, 2nd in percentage, 7th overall, and we have the 5th highest net migration into the state, the red bar. So that gives you a sense of the inflow and health in terms of people coming into the economy. 2nd highest college level in the United States, participation in the U.S. So very well educated workforce. A big issue is that 90% of the growth is along the Front Range. So we're really, that's putting a lot of pressure on infrastructure, particularly the transportation infrastructure in the state. Our forecast is for an increase in job growth for 2017 after 2 years of dipping. The 2 years of dipping very much affected by the energy industry and the negative growth there in 15 and 16. And at this point, virtually all the sectors in the state economy are growing, a slide you'll see in just a moment. One thing that does occur, however, is there disparity in the level of growth and prosperity in the state. And as you can see, when we look at the metropolitan statistical areas, all of those along the Front Range, very healthy. The furthest north, Greeley and Fort Collins, doing particularly well, some of that being driven by the energy industry, but also by high tech in the Fort Collins, Loveland area. So we see pretty strong growth along the way, and all of those MSAs growing faster and having more growth since the economic downturn than the national economy, which is in kind of a dark grayish color at the bottom there. But you don't see that prosperity on the western slope of Colorado, not as much. And you can see Grand Junction, very heavily dependent on the energy industry, the natural gas industry, and they continue to be kind of horizontal in terms of their economy. That they're not in terrible shape by any means. They're sort of sustaining, but they have been not been able to get to previous peak employment. You see that in other rural areas of the state as well, and that's that 96% of the migration going to the Front Range. It's because where the growth has been in terms of jobs. So the prosperity is not equally shared throughout all parts of Colorado. In terms of industries, as I mentioned a moment ago, we see growth across a wide array of industries. All of them except natural resources and mining are in the sort of growth phase. And when we look at that picture with natural resources and mining, we actually see rig counts and other things turning at this point. So we're starting to see a bounce back. We think there'll be maybe a little bit of job loss in the first part of the year, and then we expect to see a much stronger growth rate as we move forward in the latter part of the year and in 2018. The $50+ barrel price is allowing, what happened? I have a problem.
Yes, Rich. What is the problem?
My screen went blank.
Oh, no problem.
The GoToWebinar.
Okay, great. We'll grab you. Sorry, everyone. We'll take a minute. Rich, just come to my office and you can finish up here. And we'll get going in about 30 seconds again. So thank you, everyone, for being patient.
I'm back. Can you,
You're back.
Heather,
Great.
can you put me back on? Yeah.
Yep.
Thanks to
you should have control.
Support.
Yep, you should be good to go now.
Okay. So I mentioned natural resources and mining. I did want to make a couple of comments about that. Again, the price being up over $50 a barrel does make a difference for Colorado as well as many parts of the country, Texas, the Permian Basin, North Dakota. So we are starting to see a bounce back in rig counts throughout, and we're also, just for the people from out of state perhaps, or even people in other parts of Colorado, we're starting to see the political pushback in some of the areas close to the Front Range in terms of the continuation of fracking in the state. Colorado may be little known fact, 7th largest oil producing state in the country, but you can see the quick turn as the price changed, the quick drop in terms of the output of Colorado, and certainly nationally similar types of things occurred. So the tremendous ramp up and the tremendous ramp down, and one of the areas that this creates a little bit of problem with is severance tax revenues. A lot of the severance tax revenues go to local governments, and especially in the Colorado sharing process. So this is a significant impact on local government finance. Overall, you can see the value of natural resources has dropped fairly significantly the last 3 years with lower commodity prices. And the big drivers there, again, are crude oil and natural gas. One thing that might be of interest is you can see with all the growth the state has had in terms of population growth and employment growth over the last pretty much now at this point 7 years. Even with all of that growth in population and in employment, in terms of use of electricity and use of natural gas, we've become much more efficient. LED bulbs, a lot more, other types of insulation and heating and so on. Colorado is one of the largest percentage states for heating with natural gas. 70% of our homes are heated with natural gas. And Colorado has the 10th lowest natural gas price in the country. So we kind of benefit from that as consumers, but we're also benefiting from that as we look at overall picture. In terms of construction, a few comments about that as I close out the presentation on Colorado. We see residential construction is a major piece of the overall picture, and so when we look at residential construction, as mentioned, we have this housing price index where Colorado is again in the top 5 in terms of housing price growth year over year through the 3rd quarter. What's driving that? Well, analysis out of the state demographer's office indicates that part of the problem with what's driving that is the imbalance of what has been built, and that's housing units in the sort of red line, and then the households that are in the gray bars, and you can see significantly higher household formation than the red line, and therefore you're underproducing, and that's part of what's driving housing prices up so dramatically in the state. When we look at this picture, when we look at the picture in terms of dollars of production, and also in terms of won-back residential permits, you can see we're producing more and more housing, particularly single family this year, but it is not getting back to the level it was in prior periods. Back in 2000 to 2006 period, we were producing significantly more housing. So this is a recovery, and this is certainly being driven by the high housing price appreciation, but it's still underproducing. And again, I kind of mentioned, without getting into too much detail here, since the audience is both local and national, but one of the pieces here that we're looking at is the housing price increases are close to 10% annually, 9.8 for the last period that we have, and that puts us as the third fastest housing price appreciation state in the country at this point. And again, you saw the earlier chart that showed how we compare in terms of MSAs since the previous peak, how strong especially the front range MSAs have been. Our overall belief is that construction is going to grow, and jobs in construction will also be growing, not quite to their previous peak, but very close. They're finally finding the employees that they need, or at least some of the employees that they need. A quick comment about manufacturing. After having an absolutely disastrous decade from 2001 through 2010, we see now 7th year of projected growth. So the manufacturing industry continues to be healthy, not dramatic growth, not huge number of jobs, but many parts of the country are still losing manufacturing jobs. So we view this as a kind of a nice picture of health. And you can see that there's quite a bit of concerns out there by the manufacturing industry. Oil and gas, one of them, the strength of the dollar, since we do a lot of exporting of manufactured goods. So these are things that are concerns in terms of maintaining the growth in 2018. Closing rather quickly, retail sales have been dramatic, the increase, and you can see on the right-hand graphic, forecasting continued growth up in the 4.4% range in the overall picture. This leads to a nice increase in the Colorado General Fund, some of which is sales use and other excise, the bottom band, which has continued to go up nicely. But the state continues to have fiscal issues or concerns related to costs rising higher than the taxpayer Bill of Rights limits, particularly in the healthcare domain. When we look at the overall optimism, this is in the index we do, the Leeds Business Confidence Index. We can see that the Leeds Business Confidence Index had a dramatic jump, and a huge piece of that was related to the national economy. Our participants had been concerned about the election, but they were also concerned about regulation. And certainly the potential for regulatory reform is one of the things that's driving confidence levels in Colorado. So I don't like to just sort of say all these rosy things about the state and not put it in any sort of perspective. So I'm make a quick comment here so we leave the time for Q&A. But you can see in that very first column, there are a couple of areas that are concerned. The number 3 fastest rising home prices at the bottom, and then in the middle, the 43rd per capita personal income growth. You would think with a state that has 3.5% unemployment and all of these great jobs that we're generating, that we would have higher wage growth, higher personal income growth. So that's something we'll be watching very closely. So the state summary centers around the changing energy impact, continuing growth faster than the nation, probably top 5. That's what our number is right now, 5th highest performance in terms of job growth. but that leads to labor force pressures and a growing population with strong immigration that brings its own set of questions with it. Our external concerns are things I've already commented on: interest rates, global growth rates, the value of the dollar. We always have the concern of drought and weather in Colorado. It affects our agricultural industry and it affects our winter tourism heavily. So this year we've had dramatic snow, many of you probably know, and not just here, of course, California as well, but areas that really need water. So that has been a positive, at least so far. And then we don't know what the outcomes of policies are going to be on various parts of the economy, the state economy. We do a lot in defense, but we also do a lot in renewable energy. So we're going to keep our eyes on what comes out of Washington and how that might change our forecast as we go forward. So with that, I am concluding, and I think it leaves us about 14 minutes for Q&A, and Heather is in control. I am very thankful that you dialed in and appreciate you being there.
Yeah, thank you so much, Rich, and thank you everyone for all the questions you've submitted thus far. Just as a reminder, you still have time to submit questions through the question panel in your attendee control panel. So please submit any questions there. But to get it started, the first question we got earlier today is, what are the other assets in household wealth?
So, yeah, we should have had that print up there. So there's a whole category of other financial assets that fall into that. It's primarily financial assets. There's also, depending on how a home or a rental property is owned, also fits in there. And then it covers everything else that people might own, like minerals and other types of things, mineral leases. Those types of things fall in the other assets.
Great.
By the way, by the way, that information is from the Federal Reserve report, and you can go and get the whole definition if you wish to access. It's online.
Thanks, Rich. Another question that came through is, what is your biggest concern about a Trump administration's effect on the economy?
So again, let me lead off with, I speak for myself, not for the university and not for the regions, and all of those people have a disclaimer. My biggest concern, given the growth in the economy, is immigration reform. Also, in that category, I'm also concerned about the trade policy. Like most, I think, economists who are sort of, growth-oriented, I put myself in that category. We tend to prefer trade agreements and free markets in terms of trade. I understand completely the argument is we aren't on an even playing field, and we're going to renegotiate some of that. But the import quota type of thing, or that have been suggested, or tariffs, do have secondary effects. So there is a trade issue. But going back to my first comment, there's an issue about enough labor force in the U.S. So I hope the immigration reform will be very thoughtful. There's certainly an issue relating to agriculture and immigrants for agriculture. I hope the reform of that is very thoughtful because that could have direct economic impacts. Regardless of how you feel about illegal immigration, you do have issues related to workforce needs.
Great. Another question here is, what is the Taxpayer Bill of Rights effect, so TABOR's effect on the Colorado economy?
Well, because so for people who are not familiar, and I find increasingly a lot of people are not familiar with this, is going on 20 years we've had, over 20 years we've had in place the Taxpayer Bill of Rights that restricts the spending of the state government to a combination of the population growth rate and the inflation rate. So you add those two things together, and that's the amount of budget increase that they're allowed to allocate. This is hopefully simple enough the way I'm saying it. I'm saying it in a very simple way. There are probably people out there listening who understand the technicalities in greater detail. But having said that, that's the limitation. So population is growing at 1.6%. The inflation rate grows at 2%, in Colorado over 2% or a little bit higher. So you add those two things together and the budget number can only go up by 3%, 3.4%, or whatever the number might be. Well, in certain areas, the inflation rates are dramatically higher, like healthcare costs for many years have exceeded, the increase has been well over the Tabor limit. So when that happens, you have the budget impacts of that money being diverted away from transportation or higher education to cover needs that are fundamentally mandated, Medicaid as an example, a mandated relationship with the federal government. So all in all, I'd say the answer is I think it's negative personally, and again I'm speaking for myself. I wish the formula was different, like population and income growth as opposed to the inflation rate, and I think that would give us enough money to have a stronger investment in transportation and a stronger investment in higher education. But it is what it is.
Thank you. What is the ideal housing affordability index score?
The actual number, I don't think I know. I described how it's calculated, and that comes from the National Association of Realtors, so I suspect you could access that online as well. I don't know what the exact number is, if that's what the question is.
Perfect, great. And a Colorado question here. Do you have any information on what impacts the Colorado marijuana industry and what it, excuse me, let me reword this. Do you have any information on what impacts the Colorado marijuana industry and what impact it has had on the state economy?
So we don't, and as far as we know, no one else does either. This was a question that has come up at several of the presentations. There are pieces in the book, sections in the actual Outlook booklet that's online that address marijuana in a particular category. You know, so it's not by itself as construction is or manufacturing is or leisure and hospitality, which is the tourism industry. It sits in a lot of different areas. It sits in agriculture with production. It sits in manufacturing with being processed and changed into either other products or a refined piece, edibles as an example. And it also appears, of course, in retail because it's showing up as retail if a site is only selling and it's not doing anything else. So that is clearly generating jobs and it's clearly generating tax revenue. It appears from the tourism industry believes that it is generating additional flow to Colorado of tourists, or has, and then in certain audiences that have more social service and police type people there, and they insist it's putting an enormous burden on the social assistance part of the economy, that they have seen a big jump up since the legalization, and they don't believe they're getting any tax flows to help handle that particular issue or problem for their county. So a lot of different counties have sort of raised that issue. So if you're asking net, is it a good thing? I don't think that the numbers have been tallied. I certainly think there are many people out there who think it's been a bad thing. But in terms of tax revenues and employment, it's been a good thing. It's helped in real estate and particularly in warehousing. It has used a lot of warehousing space, so that's been really good for that particular segment of the economy. And as I mentioned before, it is generating the tax flow. One last caveat, because I'm looking at the time and it's a kind of a long-winded answer to the question. There are concerns that the tourism piece will wane with the other states, especially California, legalizing, that people will no longer be coming here on marijuana tourism, as it is called, or not as many people will. I don't know, because Colorado's a beautiful place and people like to come here. We have very strong tourism numbers anyway, so I don't know if that part of the business is going to disappear. But that concern is out there.
Thank you, Rich. We've had quite a few questions come in about recessions. What is the likelihood of a recession in 2017, 2018? And if not, then do you forecast a recession in the near future?
So this is a question on a lot of people's minds. I certainly don't believe there's one coming in 2017. I sit on the oversight panel for the National Association of Business Economists Outlook Survey. Our most recent survey for 17-18 had very low probabilities of recession in the next 2 years. Part of the reason for that is the tax cuts and spending that are anticipated with new policies are going to give the economy a stimulus. And the question then becomes, since people are asking, I think, a very nice, interesting question, very intelligent question, what happens after that? So does the stimulus of 17 and 18 really cause the economy to have to slow down a little bit in say, 19 and beyond? And I think that's open for discussion. Business cycles don't die of old age. Expansions don't die of old age, but typically are driven by rising interest rates. If you look at Federal Reserve policy, the economy's running stronger and stronger, and the Fed is putting rates up higher and higher in previous recessions. Then you sort of see the recession occur. The Fed will be raising rates in 17 and 18. Will it be enough to cause a 2019 recession? I think that's a question a lot of people are asking. Again, and to be very clear, I don't see the next recession being like the last recession. I don't see the economy, all the assets going into bankruptcy and so on and being as ugly as the last one. The last one was a financial recession. Took the banking system down, or a piece of it down, and long road to recovery. I see the next recession as a more normal couple of quarter dip. Economy cools off, and then you go back to sort of more of a positive growth rate.
Great, and we have about 3 minutes left, so we'll get through one or two more questions. One of them being, does the projected growth in healthcare employment take into account potential ACA repeal?
So the report was done in November, was due right before the election, and all of the committees were given the opportunity to change their forecasts based on the outcome of the election, and they did not. Only one or two committees did, and healthcare did not. I think the reason why largely is they are assuming that at least the first half of the year will continue as in the past, and then only after that point will we see sort of the impacts of the reform. And so, it's kind of a mixed bag on that answer, but the committee didn't feel like 2017 would be a big change. With it's repealed, you have to know what it's replaced with, and when we know that, then we'll know more for the 2018 forecast.
Great, and we had several housing questions. One of them being, is the housing pricing somewhat distorted due to the fact that they're not building mid-range priced housing, specifically I think in Colorado?
Well, I think that's absolutely the case in Colorado and in a lot of the higher priced urban areas. The price of the land is so expensive that when builders go in, they're not, mean people who don't want to supply the right product. The cost of the land is such that they have to decide what product can they build that's going to, give them sufficient profits, if you will. And consistently, they're building a product that's a little bit more pricey so the project pencils out. And the crying need, I think that this wasn't in the question, but this is in the answer. The crying need is for housing in a little bit lower bracket. And I think, if we could build in the 300, 350 range in Colorado, or even lower, 250 to 300 range, I think we would have a huge demand. And that would be very affordable for a bracket of working people who are having a hard time getting into the market right now.
All right, thank you so much, Rich, and thank you, everyone. We are now officially out of time. I want to thank you again to Rich for this great information today. Tomorrow, you will receive a link of this recording, a survey link, as well as additional resources from today's presentation. Also note that on your control panel, there is a handout area, so you can go ahead and download the slides from there today, as well as we will be sharing them tomorrow as well. To view upcoming webinars and request previous recordings, please visit our website at www.colorado.edu/alumni/webinars. And on behalf of the Leeds School of Business, thank you so much for joining us today. Have a great rest of your day and go Buffs.